Hey, it's Jeff Green with Green Financial Group. Thanks for tuning to the video blog today. Today is part 2 of our 2-part series with Brian Wesbury, Chief Economist for First Trust Portfolios. Stick around. We'll be right back. So I have some clients from Argentina, and we talk about inflation a lot. So they went through hyperinflation, and they're very concerned, and they're concerned about the inflation going on here.
Yep.
Talk to us a little bit about inflation, where you see it. Is it going to be hyperinflation? Where do you see that going?
Yeah, I don't think we have hyperinflation yet. The Federal Reserve has printed 38% more dollars since February 2020, and if you just kind of do the math and say we don't increase our output, but we have 38% more money, then that means prices, the dollar will fall 38% in value. By the way, this is exactly what happened in Argentina. The value of the dollar will fall relative to goods and services. I'm not talking about versus the euro or the yen or the pound, but relative to a barrel of oil, relative to a tomato, by 38% on average. So this is why real estate prices are up, gasoline prices, oil prices. There's other things going on with oil. We shut down, pipelines, and we made it illegal to frack on federal lands, et cetera, et cetera. But the real place that inflation is coming is from that increase in the money supply. What's interesting is Jerome Powell is saying we need to taper. We need to stop growing it. Right. Although he's going to take all the way till they should stop today.
Right.
But they're going to keep adding until next July. And I believe that the minute he said he wanted to taper, his job is over in January unless he's reappointed. And I think the Biden administration won't appoint him. So right now we don't have hyper. It's not even as bad yet as it was in the 70s, where we had 12, 13% inflation for probably 5 years, kind of on average. We're not even that bad yet, but we could get there, and it all depends on how quickly the Fed is able to reverse course. And if we're addicted to the morphine, the easy money, then it's hard for them to tighten. So that's how you get this circular problem of inflation. The Fed prints too much money. Everybody likes it because everything's going up. The Fed slows down the money. It causes things to go down. They ease up again. And so we have that. We've been in that kind of cycle for quite some time now.
Yeah, we have. And how does that ever does it ever unwind itself? I mean, what happens there?
Well,
that would be. I'm assuming that would be. This is years down the road.
Right. Yeah, exactly. And I wanted to make that clear because initially when you get the morphine, that's this past 19 months.
Right.
And I believe the next 12 months. I still think the market's undervalued. Profits, the stock market hasn't grown into the profits that are there. Now, interest rates are artificially low, and that helps us. But our argument is that the 10-year Treasury could go all the way to about 3% before the market would be fairly valued. So it would have to go over 3%. Right now, the Fed's not going to let that happen.
Yeah.
So the only thing that will stop that, the easiest way to do it without as much pain, remember Paul Volcker. So I just talk about a little history. Jimmy Carter was president, Nixon was president, and we had Arthur Burns and William McChesney Martin were the chairmen of the Fed back in the 70s. And they made the same mistakes that we're making today, but even in a bigger way. And we ended up with stagflation, and then it took Paul Volcker to come in and jack interest rates all the way up to 20%. And that's what a lot of those of us who are old enough to remember, that's what we worry about. Well, we're not there yet. We're not even close to that. So the way you put an end to this right now is you stop growing the money supply at 12 or 13% a year, which we're doing right now, and take it down to 3 or 4. And then if you did that, the inflation would be, it'd be like a rat and a snake, where the snake eats it, there's a big lump, and then it slowly but surely digests it. And that we would let the economy absorb this money. Doing it abruptly, like Paul Volcker did, is not a good thing.
Right.
And so they ought to do it slowly, which is what Powell is asking for. What worries me is that the Biden administration won't let him even do that.
Right.
And that's where we start to get a problem down the road. So I do want to make that difference, though. The next 12 months We're opening up. We're going to be adding jobs. The economy is going to be growing. The Fed is still easy, even if Powell is chairman. And as a result, I see a pretty open field to run on.
Good.
It's after that that I worry about.
Yeah. Right. And so this whole transitory notion of inflation. That's what your opinion there?
Yeah, it's not. They've changed their attitude now. They used to say transitory, it's temporary. Now they're going, well, we admit that inflation's higher than we thought it would be, but it's not permanent. Yeah. And so they're changing their words. They're moving the goalpost a little, right, which government always does. Back in the 70s, I hate to bring this up again, but I have read every economic report of the president, ever written, really, but I paid close attention to those in the 60s and 70s, and they said the same thing. They didn't use the same words, but if they would, it's 1974, and the inflation was higher than anyone thought, and they go, well, it's because of OPEC, and you hear that today a little bit. Oh, it's because we had a drought in the Midwest and the corn prices spiked. Oh, it's because we had a hurricane in the Gulf and the oil prices spiked. They always had a reason to call it temporary,
right,
and I don't, and they're doing that again today. So no, this is not transitory. The only way to fix it is to slow down the growth in the money supply, and we have to wait and see how well they do that and execute that in the future.
Right. So being from Houston, I got to ask you this question. Mm-hmm. Give us your energy outlook.
Oil, I would argue it's a little overvalued, today. I think, 65 to 70 bucks a barrel is probably, like, historically relative to all commodities where it should be. However, because we have inflation, right, gold and copper and aluminum and corn and wheat and soy, lumber, they're all rising, and that means that this is inflation. So that's why oil is priced where it is, in the low 80s right now, and natural gas, I believe, is going to head up too. So I love the energy complex. I love the inflation investment today. I wouldn't just buy just oil or just natural gas or just gold or just silver. I kind of want to own a basket. But I don't know the exact numbers on this, Jeff, but I think the last time I heard, the five biggest stocks in the S&P 500 made up well over 20% of the index. Yeah. And the energy complex, like 100 stocks or 80 stocks, I forget how many it is, maybe it's only 60, only made up 2.2. That's an imbalance. Yeah. And so I right now, if I want to put it in geographical terms, I like Texas. I don't like California. Yeah. And so that's where the value is.
Right.
And so those stocks are undervalued. And that's one of the reasons if you look at some of these massive mega cap companies, they're beautiful companies. They're some of the best companies, the most profitable the world has ever seen. But they're fully priced. They're kind of priced for. Yeah. They're priced to win the Super Bowl again next year. And the energy stocks are priced like they still can't win anything. Yeah. And that I love it when markets do that because that gives you an opportunity.
Yeah. Cool, great. Well, you heard it here first. Brian, thanks for being here today. Really appreciate that.
Thank you, Jeff.
Yeah, and if you follow on Twitter, you got to follow this guy on Twitter. We'll put it on the screen, but he sends the best tweets out there ever. Thanks again.
All right, thank you, Jeff.
Thanks for tuning in the video blog today. Remember, any questions, concerns, or comments, feel free to call us. Remember, stay the course.